Good morning friends, welcome to the point. In this video we will take up another concept related to financial markets, that is exchange traded funds. So let us start with the video. For any economy to prosper, there's a backbone that needs to thrive, that is the financial sector of any economy. And this financial sector can work properly only if the money is invested properly, it is circulated in economy properly, and it is put to productive use. For an example, if most of the citizens of a country start saving their money or depositing the money in their house and not putting it back into the financial sectors by the way of depositing in banks or stock markets, then the money is just like a dead investment. For an example, most of the income that you earn, you are saving it in a bank account and not in savings, that is bank account, that is the locker that the bank gives you, or putting in your wardrobe and not investing in the financial market or depositing it with banks, then this is termed as dead investment. Or let's suppose you are buying a gold bar. So now that gold bar will not serve any productive purpose to you. It is just a gold bar that you are keeping it for your future and is of no use to the economy since the money gets blocked. So all of such investment is considered as dead investment, as it leads to no productivity in the economy. Had this money you deposited by you in the banks, in let's suppose fixed deposit account, so by using this money, banks could have extended loans in the market to the people who wanted, and those people could have put it to productive use, maybe by setting up a factory or expanding their existing businesses. So that money is considered to be put in productive use. Now I hope you are clear with this concept that in order to make the financial sector of an economy robust and strengthen it, we need money to be circulated in the economy and to channelize it into more productive sources. So this exchange traded funds is one of the way that the money can be channelized and routed to more productive uses. As the name suggests, that it is a fund that is traded on exchange. An exchange traded fund is a basket of securities that trade on an exchange, just like a stock, like the way the stocks or shares of a company are traded on stock exchanges like BSE and NSE. So NSE is a basket of 50 shares and BSE is a basket of 30 securities or shares. So like the way the shares are traded on these two exchanges, exchange traded fund or ETF is also a fund that is traded on such exchanges, where the difference lies that this is here the individual shares are being traded, but in case of exchange traded fund, it is the basket of security. Now what is this basket of security? Let's suppose I am creating a fund or pool or a basket in which I have 6 shares hailing from different companies. Let's suppose it has securities from Reliance Industry, there is Tata Power, there is PNB, there is HDFC, there is some stock from pharma sector, let's say Sun Pharma, and there is a stock of MRF tires or MRF company. So now I'm accumulating the shares of all these companies and making it a fund which is known as exchange traded fund. So by the basket of security, it means there are so many different variety of stock that is put into this basket, and this collectively, this basket which is converted into a fund is being traded on an exchange. It reflects the composition of an index like BSE Sensex, and its trading value is based on the net asset value of the underlying stocks such as share that it represents. So these funds are traded on exchange, as I've told you, and this basket could just not include the shares, but it could also include indexes, or it could include commodities, or could include bonds also. So it is not necessary that the basket would have just the shares of different company, it could have bonds of different companies as well. Now what is the difference between share and a bond? So whenever a company wants to raise money from the market, it has two options. Either it could issue bonds, or it could issue shares. Now the share represents ownership in a company, whereas bond is just like a loan that the company raises from the market. So this basket could also have bonds of various company. It could have different commodities and could have indexes. So the value of this basket would depend upon whatever we put into this. ETF share price fluctuate all day as it is bought and sold and is different from mutual fund that only trade once a day after the market closes. So the value of this ETF keep fluctuating throughout the day as it is bought and sold continuously. So the value keeps on changing. An ETF can own hundreds or thousands of stocks across various industries, or it could be isolated to one particular industry or sector. So in this basket we could just include share from one particular sector. Let's suppose I am making a basket of security of all the stocks hailing from banking sector. So this would include stocks that pertains to banking industry. Let's suppose PNB, there is SBI, Yes Bank, HDFC, Axis Bank. But also at the same time I could make a diversified basket which could include some stocks from banking industry, some from power, some from pharma, some from FMCG. So it is not restricted to one sector. It could be a diversified one including stocks from various sectors. So there is no hard and fast rule relating to making the basket of securities. I hope it is clear as to what exchange trade fund means. Any fund that is traded on exchange is exchange traded fund. Now the value of fund is dependent upon whatever things we are putting in the basket. Let's suppose you go to the market to get a hamper for your friend. So the value of hamper will depend upon whatever things you put into that hamper. For an example, you are buying chocolates, you are putting a soft toy into it, you are getting some souvenirs into it. So the total price of the hamper would depend upon whatever things you choose to put into it. Same ways in the case of the funds, that the basket would depend, the price of the basket would depend upon whatever stocks or bonds or anything else we are choosing to put into the basket. I hope it is clear to you by now. The next slide is what all can be included. Bonds, as I've told you, stocks, foreign currencies, oils, futures, gold bar. Fine. So this all can be included in the basket. Next is the the types of ETF. We have studied as to what all can we include, but there are 4 type of things that is allowed in India to be put into the basket. They are equity, debt as in bond, commodities, and overseas equity. Now what is this overseas equity? Is equities of companies located outside the territory of India. So that is overseas, that is the foreign companies equity. So only these 4 things are allowed to be made part of the exchange traded fund. Moving to the next slide, that is what are the benefits of investing through ETF. First is the benefit of diversification. Yes, you are diversifying your risk. Let's suppose there is a basket including stocks from pharma, there is power, there is FMCG, and there is let's say banking. Now even if FMCG sector is not performing well and the shares are dipping, but these 3 sectors are performing well, so the risk that you have undertaken is not is a diversified one. So even if this is going into loss, but these 3 are picking up, so your risk is diversified as compared to if you are just concentrating your money in one particular stock of one particular company. So the risk gets diversified when you put your money or invest your money through exchange traded funds. It provides liquidity. How does it provide liquidity? Because it is traded on exchanges, so you can easily sell it whenever you need the money back. So it provides liquidity to you in this way. It provides you ability to invest in small amount. So there are certain stocks that are very expensive and you need really huge chunk of money to buy the shares of that company. For an example, MRF. So one stock of MRF is somewhere trading around 59,000 right now. There is Shree Cement Limited. Their stock is somewhere around 19,000. So to buy one share of SCL or MRF, you need around 59,000 rupees. But whereas if you consider the case of ETF, you can just put there are so many securities that are put in here. It could be one of the part could be allocated to MRF securities as well. And since there are so many people pooling in money in this fund, you don't need to get 59,000. Only the chunk that is allocated to you, there is a very small amount that comes to your part. By that amount only you can invest in ETF, irrespective of how much expensive the stock is. And the last point is simplicity of transaction. It is very simple to transact through ETF. You don't need any fund manager or broker in between to transact in ETF, because it's very simple to buy and easier to sell, and there is not much of technicalities that is involved. So these are the 4 major benefits of investing in ETF. The last part talks about the Bharat 22 ETF. So this is a ETF launched by Government of India, and this is in news too much these days. That's why I thought of updating you with this. Now this Bharat 22 ETF involves, as the figure you can see, 22. So there is a basket constituting 22 securities, and the company to which these securities hail from are the government companies. As it is written here, it consists of stocks of CPSC and PSB. PSB is public sector banks and CPSC is central public sector enterprises. So and the sectors, the Bharat 22 is a well diversified portfolio, and it involves 6 sectors. That is, these company hails from 6 different sectors. But one thing that you have to notice, that all the companies these 22 companies are the government sector companies, and the government is planning to disinvest their portion or their share. That is why it launched this Bharat 22 ETF. Now these 6 sectors from which these companies hail from are basic material, energy, finance, FMCG, industry and utilities. Here I have put this news clipping also, and it mentions as to which all companies the government is trying to include in this. So in energy, it is considering ONGC, IOC, BPCL, FMCG. In this, it is ITC. In utilities, it is thinking to include NTPC, GAIL, NHPC, and finance in the public sector banks, these ones. So I hope it is clear as to what exchange traded funds are, what are the benefits of exchange traded funds, what is this Bharat 22 ETF. It is launched by Government of India and not held by any private, or it is not promoted by any private bank or individual or a financial institution. And these 22 stocks denotes their shareholding of 22 government company in which the government is planning disinvestment. So friends, this is all for the today's video. Stay fit, stay at home. Please keep revising such concepts thoroughly and try to remember them by examples. Thank you so much.